All right, great. So yes, again, cool. So today we'll be starting off with what is Forex. We all been hearing what Forex is. We all know it gives shit ton of money. But we don't, some people don't really know. Is it so big? Is it that big? Is my Zoom making it that big? I feel like it's my screen is that big. Let me choose a particular. Let me see how it's gonna go right now. Is it any better now? Is it better now? All right, cool. Because I have like a really big ass screen. It's like a 49-inch whatever, and it stretches out things to people that don't have the same screen as me. Cool. All right. So yeah, we know what about like Forex gives money, whatever. Everybody wants to learn how to trade to make money, but you don't really know what Forex is about. So this is something about Forex. Forex is not like crypto. Forex is not no thing that will come today and will disappear tomorrow. Randy, I'm gonna put you my co-host. You're gonna assist me with admitting people into the call so I don't get distracted. If you're cool with that, bro. I'm also make him man my co-host as well, because those are like people. Yeah, could help me admit people into the call. So I want you guys to understand that the foundation of Forex is something that you cannot get scammed in unless you let yourself get scammed in. Like literally. Like Forex has to do with banks. The way we have like BSEC banks, credit, whatever banks that are back home, those type of banks, like I've like forgotten a couple of them, but so those banks, right, are literally trading our money in what they call the foreign exchange market, and that market has been for the longest of time. This thing is not Forex is not just coming in the 2000s. Forex is not just coming in the 90s. Forex have literally been for as long as money has existed, for as long as the banking system has existed, because Forex is literally the trading of currency pairs. And it's like, how today you look at $1 might be 500 francs, or $1 might be 600 francs. So that change in the exchange rate, that change in the currency in the exchange rate, right, is what we predict here in the Forex market. Is you're looking at it and being like, oh, okay, if it's like it's a dollar against the CFA, you're gonna predict that the dollar is gonna go up or it's gonna go down. Like that market's gonna go up or it's gonna go down. So we are literally looking at certain factors that we will be able to use to determine if the market is going to go up or it's going to go down. So we're literally trading that change in value. That's what you trade in the Forex market, that change in value. And not everyone can trade it because you need to know how to predict it properly. But like everyone can have access to trade it, but not everyone can know how to trade it. You can have access to trade it because you could have what they call a broker. Everyone nowadays have access to it, though some of them will say you have to be above 18 years. Some of them literally there's no KYC verification. You can just trade even if you're 16 years old. And yeah, so everyone has access to a broker now. You can put in, majority of them require you to deposit your funds using crypto. Others, you might do a bank-to-bank transfer. But us here in the United States, actually, it's all about like cryptocurrency. We barely have, I haven't really seen a broker. Um, I haven't really seen a broker that we can do bank-to-bank transfer. Like it's always, oh, you have to do crypto, whatever. But like, yeah. So as I go about, you guys could literally be taking screenshots of the screen, so something you can read later on, because I won't literally be reading everything word to word on here. I won't be like, oh, reading everything in details, but this is like, you can be taking screenshots of the notes we'll be going over today. So this is this again, what is Forex trading? Forex trading is the buying and selling of global currencies, just like I said, but in that case, I give an example using, the dollar and the CFA. It could be the dollar. It could be dollar against euro, euro against Australian dollar. There's a lot of things you could trade, even sometimes. So that's like, I'm not even going to that. So it is how individual business, central banks, and government pay for goods and services in other economies. whenever you buy a product in another currency or exchange cash to go on for the days, you're trading Forex. But at that point, you're not being profitable for it because you're like, oh, I want to change this money to this amount of money, but you're not making any profit from it. You're like, go, oh, Alaji, change me this money to this or whatever, and they give you 10,000 francs. You give 10,000 francs and they give you, I think, like $20, something like that. At that point, you're not making no profit, But people like us, when you start trading Forex in the market, when you put in some money, like say you risk that 10,000 on one trade, you could literally double it or you could lose it depending on how good a trader you are. So, however, the vast majority of the Forex traders earn for particular purposes. Speculative FX traders seek to profit from fluctuations in the exchange rates between currencies, speculating on whenever one will go up or down in value compared to another. Just like I said, we're trading that exchange if it's going up or if it's going down. The beautiful thing about Forex is you make money if it goes up or if it goes down. The thing is you have to be on the same side of the market. With cryptocurrency, you can only make money when it's going up, right? Some people here probably bought BTC at 60,000. Now it's at what, 20 something? I don't even know. I don't even look at my crypto no more because I'll literally be mad. But someone that bought it like at 60K and it's down at like the 20Ks now, so 30 or whatever it's at, that person has lost a lot of money. But if you bought it at the bottom and it went up, that's when you made money. Forex, you buy, you sell, you're making money either ways. So how Forex trading works? Forex is traded in pairs. Forex is not traded just in single currencies. Like I was giving an example using Euro, US dollar and CFA. I don't think you even see that when you want to start trading. It is there, but it's a very ugly chart. You wouldn't want to trade that. US dollar against Euro against US dollar, Australian dollar against US dollar is all in pairs. So at that point, you're analyzing the chart and determining if Australian dollar might go up and US dollar will go down, or US dollar might go up and Australian dollar will go down. So that's like, that's what you're predicting. So all this, you can just take a screenshot of these. It would be like explain a little bit more in depth. So in the in the Forex world, there's like major pairs and minor pairs. So we see major pairs are like things like AUD USD, Euro USD, GP USD. These are like most trade currency pairs you see anyone always trading. I, for one, I trade AUD USD a lot. I've made a lot of money off this pair. Some people might say it's a very slow pair or whatever, but it's literally my favorite pair because like I have a certain level of understanding and confidence when trading it all the time. Euro USD, I probably traded like 2 or 3 times. GP USD trading now and then, Yeah, and I also like frequently traded pairs as well, like GJ. People love GJ as well. GJ gives a good amount of pips, but those sometimes it can be really spiky. They show GBP and there's like NZD, JPY as well, all those type of things. There's a lot of pairs, a lot of pairs. So there are like exotic pairs as well, which are these are currencies of developing countries that are paired with a major currency. So something like USD CFA will fall under an exotic pair because it's like a developing country or whatever. But you will realize that you will be trading in majority of the major pairs rather than exotic pairs because you get to understand something called spread. The spreads for these pairs are not really nice. It's really, really ass to trade it. Their commissions is just not the best. Though the pairs do give a lot of pips, but the spread as well compensate for that pips because before you get your entry, it's gonna be hilarious. All right, so chapter 2, how do you trade Forex? So we're going more in depth on it. Okay, now that we know what Forex is and what some major and minor currencies are, let's start learning how to trade and make money out of Forex. But first, let's get into the terminologies. You need to know the terminologies. All these are really important for you beginners, since the first call we had you guys told me a lot of you were beginners. So that's why I'm going through all of these. I didn't just go into like, oh, this is how I trade, this is how I'm looking now. Because if I'm using certain terms, it won't make no sense to you. It's like you just entering the first day of class and your teacher is just going straight into the teaching and not going through the formulas of how the formulas that they'll be using throughout the teaching. So it doesn't make no sense. So the base currency, also called the transaction currency, is the first currency appearing in a currency pair quotation. This is the base currency. Code currency is the second currency, which states how much of the code currency is required to buy 1 unit of the base currency. So here is the code currency. Euro is the base, US is the code, Euro is the first. You know, sometimes in Miami, I'm gonna just select primary or secondary. I'm gonna switch it up now and then. So another terminology we use in trading is the term long. Long meaning to buy a currency. If I say I'm going long on Euro USD, meaning I'm buying Euro USD. But honestly, I personally, I don't use that terminology a lot. I'm gonna just say buy straightforward. I'm gonna just say sell. Short means to sell the currency. So exchange rate, this is how much of a code currency it takes to buy 1 unit of the base currency, or how much of the code currency you would get for selling 1 unit of the base currency. Again, if you want to, you could take a screenshot of all these to make it easy for yourself to put it in your notes. Oh my God, right. All right, I'm gonna skip all this right now. I'm gonna just go into what is called a pip. So a pip is like the unit of measurement of price that we use in Forex. You know, everything needs a unit of measurement. How tall the person is could be measured in centimeters, or it could measure in feet. The distance for, like, you know, a road, kilometers or meters, those type of things. Water, liters. In the United States, we use ounces. Those are the different unit of measurements. You got kilograms or you got pounds. But when it comes to Forex, we have what is called a pip. There is no synonym for this, it's just a pip. And which stands point in percentage. The meaning of a pip is point in percentage. Is a unit of measure used by Forex traders to define the smallest change in value between two currencies. So there is the pip, and then there is the pipette. The pipette is like a point, like the little, it's like a fraction of a pip. But again, I'm not trying to teach you guys so much knowledge that is not going to be useful. Honestly, we don't use pipettes. We just go directly into pips. Like, I'm not going to cloud your mind and teach you everything. You know, it's like the essence of me to help you guys with all of this is that I'm trying to make it easy for you to know what to know and what that doesn't really matters in trading. It's like buying a whole physics book by yourself. That's why you need a teacher. You need a teacher to tell you what is most important for you to read in that physics book, because you can't read everything. So I hope I didn't pass the calculation of the pip. Let me make sure I didn't pass the calculation. Let me read through this. All right. So how to calculate the value of a pip? The pip value is calculated by multiplying 1 pip, 0.001, by the specific lot contract. We'll come to what a lot size is. For standard lots, this entails 100,000 units of the base currency. And for mini lots, this is 10,000 units. For example, looking at Euro USD, a 1 pip movement in a standard contract is equal to $10 and all of that. Being able to calculate the value of a single pip helps Forex traders put a monetary value to their take profits, target, and stop losses. So this is quite important, because if you don't know how to calculate your lot size with your pip, you definitely lose your account. This is how you go about putting your money on per trade. So there are three different types of lots. Now we're coming to what is a lot size. If I'm going kind of fast, you let me know in the comments in the chat so I can slow down. If you have a question, you go ahead and still ask in the chat so I can explain. I'm here for you guys. You know, I've been experiencing this thing, so I might just be talking and going and thinking you're getting it, but you're not. So don't be shy. Ask any question you have. No question is a dumb question. We all here to pick up knowledge. This is not something that we learned from any primary school or from any middle school or high school, so or any college. So go ahead, ask any question. No question is a dumb question, guys. There are three main types of lots. The micro lot, which is 1,000 units of the currency. The mini lot, which is 100,000 units of the currency. And then there's a standard lot. This was 100. No, this one was 10,000. Then this one is 100,000, which is the standard lot. I can read units of the currency. So all of that is literally gonna be abbreviated, or it's gonna be written down as, you have 1,000 units will be written down as a 0.001. It's not gonna be written down as 1,000 units. It will be written as 0.001. Mini lot is written as 0.01. A standard lot is written as 0.1. And the volume is 1.0 actually. That's the volume that it actually carries, which means in the value in US dollar is $10 per pip. So if you have a trade, right, and you're trying to put $10 per pip, this is how you make money, and this is how you lose money in trading. You put didn't get the pip calculation well, bro. All right, from this you understand it better. Forget about all these units right here. On this example, I'm going over it right now for you. So let's say you're trying to get into a trade, and that trade you have what is called, let's say your risk, what you want to risk on that trade is showing that you have 5 pips against you for that trade if you want to risk on that trade. And if you want to make that trade, you're looking forward to catching, let's say 15 pips. Okay. And you want to decide on your lot size. So if you put 10 lot, right? If you put a standard lot, a 1.0 to 5 pips, how much are you going to lose? You're going to lose $50 because 1.0, the value is $10 per pip. So if that trade goes against you 5 pips, you lose $10. If that trade goes in your favor, you make $150 because you were aiming for 15 pips. I'm just saying, in the case where it gets to 15 pips, you make $150. In this case where it's a 0.1 lot, which is a mini lot, you will make $5, and sorry, you will lose $5 if it goes against you, and you make $15 if it goes to your favor, because it's $1 per pip. We're literally just using that lot size and just multiplying it. It's like you know your pip count, and you know your lot size, you know the value of that lot size, and you multiply it. Does that make sense to you now, Siddiqui? To everybody, does that make sense to you? I wanted to share my entire screen so I could like literally be demonstrating, but you guys said my screen looks small, so all right, great. So that's one thing again I want to tell you guys in trading, that don't let when you see people making $1 million, or they're making like $7,000 in one trade, and you have $100 account and you're trying to do more than what that account can handle, because those people are literally, they have a lot of money in that account, so they're using like 100 lot, 200 lots, so they're easily making money, a large amount of money. So when you guys are starting out as beginners, what you should focus on is the consistency of catching pips rather than the money. So focus on the pips rather than the money right now, because I don't believe a lot of you guys have that much money. But if you do, that is great as well. You can be using your standard lots, but majority of you guys now will be starting off with the micro lots. So we've done with lot sizes. Keisha said, you know, you didn't Oh, it's my screen. Okay. So margin is the amount of money a trader needs to open a trade. Let me go ahead and open this real quick. Yeah, margin is the amount of money a trader needs to open the trade, while leverage is the ratio of the trader's fund to the size of credit provided by the broker. So an example, you guys will probably want to open, when you get to the stage where you want to open a demo account, the broker will ask you what leverage you want to use. Do you want to use a 1:100, a 1:200, or the max is always a 1:500. I have seen the 1:1000 before, but that's in very rare cases in a lot of brokers. A lot of brokers don't use 1:1000. A lot of brokers, the max they have is 1:500. My broker personally is 1:500 as well. But I use one of my accounts, I use 1:100, 1:200, and I used to use 1:500, honestly, but I don't trade that way no more where I'm mixing too much like I used to. So it's different. So swap, this is a fee paid to the broker for position that roll over to the next market day. Well, sometimes you earn interest on your trade instead of paying. So I had these trades where I had a whole swap for, I've been trading for this account and I have a very big ass swap. I don't know if you guys, can you guys, it's too bright. Let me reduce my brightness. So swap is holding the, let's say today, if you enter a trade today, the market usually closes at 5 p.m. Eastern Standard Time. That is like in the United States time. I'm saying in my time because I can't really be converting back home. It's kind of confusing for me. So Eastern Standard Time, if you get in a trade and you're still holding that trade, you haven't closed that trade, your broker most likely will charge you a fee to carry that trade to the next day, literally to the next day. Does that make sense to you guys? Like you enter a trade today, you keep on holding that trade to the trading day gets finished, but you don't close that trade. So you carrying that trade to the next day will cost you a fee for your broker. I don't know how much it will cost, but it will vary by what broker you're using. So that's what it's called, a swap. So you might see sometimes you close your trade, you might have like swap fees or whatever. That's for you carrying. All right, great. You guys understood that. Yeah, it was pretty simple. It was not for that's a minus. Just it is better to take a lower leverage because when you take a higher leverage, your higher leverages give you like a bigger room to open more trades with small amount of money. In the case where you have like say like a $100 account, you might you having to, the broker might give you a big leverage of 1:500 and you can open so many positions where if where you literally mixing more than half of your account at once on that trade. The importance of having a smaller leverage is if the trade is going too much against you and you don't have a stop loss, the broker will kick you out even before you lose too much money. Like if you have like a $100 account and you have a 1:100 leverage, for example, and you're losing a trade and you don't have a stop loss, the broker might kick you out at like when you've lost like $30 and it leaves you with 70. But when you have like a 1:500 leverage, the broker will keep holding it till you might lose like $70 and then it kicks you out and you're left with 30. So you understand the difference in leverage now? Like it allows you to take more risks. Leverage allows you to take more risks. You can use it wisely by adding like more entries while in the trade. You're stacking entries while in the trade. But if you don't know how to use it properly, it will lead to your downfall as well. So that is like the benefits and disadvantages of leverage right there. But for you guys, I will advise you to 1:100 leverage. Swap applies to as long as you carry the trade to the next day. the swap will apply. But if you trade today and close that trade within the trading period day, you won't have no swap to pay. Does that make sense? All right, cool. Okay, so when can you trade Forex? You need to know the different sessions to trade Forex. Like you can't trade every single, not like say you can't trade every single day, but trade Forex is 5 on 7, so 5 days a week. And you trade it from, it's open round the clock. It's just closed sometimes from like 5 p.m. Eastern Standard Time to 6 p.m. Then the market opens back up. So usually at that time when the market's approaching 5 p.m., I usually like, it's not the best time to enter trades, but if you're already in a trade, you can keep holding your trade. But to enter a trade at that time is a very, very bad time to enter a trade because the spreads just become wider and it will give you like, if you're trying to get in at price at 5, the market will put you like at 7 or maybe at 3, depending on what type of order you're putting in, if it's a buy or it's a sell order. So a lot of people now asking what time or day can I trade Forex? Can I trade Forex market? The simple answer is anytime during the week. Well, the Forex market is 24/5, but that doesn't mean that it's buzzing with moves the entire day. This chapter will help you know what times the peak moves are so you can make money rather than getting stuck in still market. You guys should get to understand along the way that depending on what pair you trading, and you need to understand what session to trade that pair in. Like if you're trading a pair like AUD USD, you realize that on the 70% of the time the market moves during New York session and during Asian session. Why, you may ask, is because odd falls under the Asian banks. So if the banks in Asia or like in Australia are open, that means money is like moving, right? And during New York session, the AUD USD has USD there, so definitely USD is moving. Like the banks in America here are moving as well. The banks in America are moving as well. So the best time to trade something like AUD USD is during New York session and during Asian session, because that's when you see the best of moves. It will move during all the other sessions, but the best of moves happen during those 2 sessions I'm telling you about. So we have Sydney open, which is 7 a.m. And then actually, let me use Eastern time. Sydney open is 4 p.m. Eastern. These things you can literally Google it and be like, Forex sessions, West African time, Forex sessions, whatever time you're at in the world. I don't know where people are from, like everybody on this call today, but I know majority of the people in here are from West Africa, Central Africa. I have some people from the Dominican Republic as well, from Nepal. So you can Google it and be like, Forex sessions in your time zone, so you can know. Like in my time zone, I know Sydney session opens 4 p.m. or the like. Tokyo, actually it's 7 p.m. because this thing right here is just, Sydney and Tokyo are basically the same sessions. Sydney and Tokyo are the same sessions. They interlap, while London is during 3 a.m. my time. It's 2 a.m. here because we have time changes in America. Sometimes we're 6 hours behind, sometimes we are 5 hours behind. So it's kind of like complicated. It's just what it is. But on this one, when I made this course, we were doing the winter. It was during the winter and we're 6 hours behind. And London session was literally opening up at 2 a.m. instead of 3 a.m. So London session open at 3, it closes at 12 p.m. Yeah, like yeah. And New York session opens every day at 8 a.m. in the morning. 8 a.m. in the morning here is gonna be like what, 1 p.m. your time? Time really matters on trade. What do you mean time really matters on trade? I don't understand that. Could you just elaborate a little bit more? So all these sessions will matter when it comes to like trading pairs. For like example, let me show you. Let me share my screen on this. All right, so we've learned that is Sydney session, which I said Sydney session, AUD, USD. It's better to trade it during Sydney session and during Sydney session, which is basically Asian session, and New York session because it has the dollar and it has Australian dollar in it. So those two things are being traded. The banks are open at that time of the day. Like they are trying to make you trade pairs during the working hours of the banks of that day. Like at that time where something, let's say for example, for a pair like, let me say a pair like Euro AUD, it's still going to move during New York session, but the best time to trade this type of pair is during Asian session and London session because it has Euro. Euro dollar is in Euro. It's in Europe, right? It's basically used in Europe. So that's London session. Australian dollar is used in like yeah, Australia basically, and in Asia basically. So you better to trade it during Asian session, which Sydney session falls inside. Sydney is in Australia, so that's why like Sydney session, Tokyo session all comes together to form what is called Asian session. So let's not confuse ourselves by talking about all of them. Let's just conclude that okay, Asian session is Sydney session and Tokyo session together. So the best time to trade Euro AUD is during London session and Asian session. You want to trade something like UCAD, the best time to trade UCAD is during New York session. Why only doing New York session? Because USD is when the New York session is when the USD banks are open, and Canadian dollar is literally we have the same time zone. We're not too far apart from each other. So you want to trade USD CAD at that time of the day. Why do you want to trade these things at that time of the day? Because you sometimes you notice that the pair, it might consolidate during a certain session because the banks are not open. People are not trading money because the banks are not open. Or like you probably see moves, and at that time, the moves will not be clear, the moves will be manipulated. In this market, there is manipulation. They're like at that point, you have the big banks that are like not like banks, but big hedge funds, big companies that are trading, like private companies that are trading, and they're like moving in the market and taking people's money. Like we are literally fighting against smart people, very, very smart people that they're not out to give us money. They're out to take our money. So you have to be smart enough to know like, okay, these people want to take my money. I won't give them my money. This is how I'll trade. This is how I'll do this. So they don't take your money. So you gotta be wise about all of that. Something like gold is the best time to trade gold is during New York session. But there was a time where gold was moving massively during London session. But anytime is pretty good to trade a pair, but those are the best times to trade a pair because in trading we deal with probabilities only. So the time plays a role on the base currency. Like not really. The base and the code currency are very important as well. So both of them, that's a very good question. Help me. I hope I said your name correctly because I'll be trashing people's names. Both times matters. Like both pairs matters. The base and the code currency does matter. So if you're trading a pair, it should be related to the base currency and to the code, like the session you're trading. It should be at that time. Like I, for one, if I'm trading gold, I'm trading gold only during New York session, like only during New York session. And trading it at that time it gives me a higher win rate compared to when I traded at random times. Because at those times, I don't really see as much volume or there's like more manipulation in the market. Uh, if you find good opportunities out of the sessions, you can still take it. You can still take it, that's fine. But the thing is, at that point, it reduces your probability of you winning a trade by a little bit, but not by too much, but just by a little bit though. I'm not saying it's gonna drastically reduce the probability of you winning that trade, but you can still trade it out of the session. I'm just saying the best times. That's why I said the best times. I didn't say the only times. I said the best times is to trade it within the session. I like how you're asking the question. That shows you guys are actually paying attention. So that's good. You're welcome. So this is what I was telling you guys about the pipette, but the pipette is not really necessary too much. Honestly, you guys will not need this. I, for one, I don't even use this. Rather, they even use the pipette. Hey man, these guys even use pipettes. We just pay attention to pips. We don't pay attention to pipettes. Like the brokers will not even give you an opportunity to have a pipette stop loss. It's too small. But like this was just an example, like in Euro USD for price, where you see like 1.24647. All of these are like basically pips. They're all pips. Some of them will have the last, something like USD JPY, the last number will be like a pipette. For some pairs, the last number will be a pipette. But since there's a tool that you can use to literally measure your pips, you don't really need to know how to really manually calculate pips, because this thing is like, it's really fast. You need to be thinking fast. So there's no time to be doing the maths and like, oh, this is 10 pips here. Yeah, there's just a tool on TradingView where you will go ahead and just like, put that transaction costs. All right, transaction costs. This is known as a spread. It is a fee charged by brokers for giving you the service to take trades. This is how non-commission brokers make money, as the fee is calculated within the exchange rate. So, like I said, the spread. Let's say, for example, you're trying to buy. Is this sharing TradingView? Oh, my bad. This one I wanted to just share my full screen, but I couldn't. So let's say you're trying to buy AUD USD, right? You're trying to buy. These are right now. Trying to buy AUD USD at current price is at 7. So depending on the spread of the broker, when you get into that trade and you're trying to buy, the broker will instead put you behind price. You will never, it's barely, there's barely a good chance that you enter exactly where price is at. So if price is coming at 7 on TradingView and you want to get in, the broker will put you at 6. So you're 1 pip behind. So your order would need to fill that 1 pip before going into profit for you to start. Like then for you, that spread that you went behind is like the commission you paid for that broker. So that's why I was saying that during 5 p.m. EST to 6 p.m. is the worst time to trade, because if you want to get in a trade at that time, the broker might even take you to maybe 3 and they'll put you 4 pips behind. 4 pips is a lot of money. It's a lot of money. So if anything, avoid trading at 5 p.m. and 6 p.m. Wait, if you have a trade set up, getting that trade after, like getting the trade at like 7 or getting before the market does what it does. You do all that before the market does that. So if you're trying to get now for a sell at 7, the market will instead take you at 8 before bringing you down to 8, 7, 6. So that difference in 1 is what is called a spread. Like, so don't be surprised when you get in the trade, you realize that, oh, you're in drawdown. You're in drawdown before you go into profit. Like that spread is a little commission you do. So that's another thing about choosing brokers. You need to make sure you're choosing the brokers with lesser spreads. I'm giving an example of just 1 pip, but some brokers actually have a spread of like 2 pips or 3 pips. And depending on what instrument you trade, what pair you trade, the spreads vary. Some spreads are more. Like the spread for GBP USD is more than the spread for AUD USD. The spread for Mexican USD vs the Mexican pesos is greater than that of GBP USD. So like earlier we had talked about the major pairs, the minor pairs, and the exotic pairs, right? So those exotic pairs have greater spreads. That's why people don't trade it that much. People don't like when they're getting to trades, price is taking them like 5 pips behind before giving them profits. Nobody wants that. So that's why I personally like AUD because it's like a 1 pip or probably like a 0.5 pipette, or it's like a sorry, it's like a 10 pip 5 pipette, which for the spread, which is very, very less. So something about choosing your pairs as well, you want to choose something with less spreads. So the spreads make sense to you guys? So what you're trying to say is according to time for trading periods, huh? You mean the spreads is according to the time of the trading period? Is that what you're asking? Like spreads will vary with the trading periods? Is that your question? Is that the question? Yes, it does impact limit orders because it has to fill that spread first before activating your order. So sometimes you might have price at a certain level and literally it doesn't fill it. It doesn't fill it, then you literally come so close and it doesn't fill that order limit order, and then it goes back. I personally use only market execution. I don't like limit orders. Like I like watching my shit happen, then I trade. You guys give me a quick second, please. I'm sorry. Let me take this call. Sorry about that, guys. Any other questions about spreads? I'm glad you guys are enjoying it. Thank you, Brody. All right, I'll take that. You guys understood that. No questions so far. So there's the next we'll go to is on unrealized profit and loss. So also known as floating profit slash loss. This is like profit or loss in your current open position, floating because the trade isn't closed yet. So a profit could become a loss and a loss could become a profit. These are unrealized profits slash losses because trades are still active. Once trade is closed, you have a realized profit slash loss. In this case, this is a realized loss, which was a 32,000 loss. In this case, it's a realized profit, which was I think like 18K profit. Unrealized loss right here is a 9K because it's still floating. You know, sometimes you go in for people that have at least traded before a little bit or traded to some extent, you could get in the trade, you could go into drawdown before going into profit. So that drawdown you're going to is called unrealized loss. It's only realized loss when you close the trade. The same thing when it comes to the profits. You could go into profits, that's unrealized profits. So you close that profit because before it becomes realized profit. And like you said there, profit could turn to loss and loss could turn to profit. That's why some people might hold the trade for probably like 3 days, hoping it's going to come back to profit. But sometimes it's never going to come back. Maybe it might, maybe it might not. It varies. So that one, like, that was pretty simple, right? I bet you guys got that. If you got it, you drop me one in the chat so I know I can move forward. All right, cool. So another thing is called the balance, which is the total amount of cash you have in your trade account. This value will only change once trades are closed, either in a loss or profit. That's very straightforward explanation. Equity. This is the balance plus the floating profit of open trades. So equity is like, it just shows you like it says the balance of the this is the balance plus the floating profits of the open trade. So if you have an account probably like at $100 and it's floating in $10 of profit, equity will show it at $110. If you have it at $10 of loss, it will show it at $90. So equity just shows you like the total amount of profit plus balance or loss plus balance. So margin requirement, amount of margin required to open a position like, all right, this is very leverage stuff. Amount of margin required to open a position expressed as percentage. Example, if you open a $5,000 mini lot position with a required margin of 2% of 50s to 1 leverage, $100 will be kept aside during the trade and can't be used to open other positions. So how can I explain this in the simplest of terms? And like this is kind of like an advanced, I feel like it's kind of like an advanced something where you understanding more with experience. I'm trying to look for where. I don't want us to dangle on these things for too long because the real source is still ahead. Yeah. But like I said, if you guys use the 1:5, 1:100 leverage, you won't even need this. So we're gonna go past that. I'm not trying to teach you guys to trade like South African traders. Those people just put money on like, is that they make money or they lose money. They don't really, I don't know how to trade, but yo, they just stack on entries, and that's why probably they have 1:100 and 1,000 leverages. All right, so I'm gonna start explaining at stop out levels. So stop out levels, the level of percentage where the margin level is equal or below it. Your broker will automatically start closing your positions. You need the margin level is greater than the stop loss out level. So this thing like this right here is what I was telling you guys earlier about being too much in the loss where your broker will start closing your trade by itself. Like you will not even put a stop loss there. The broker will just close the trades by itself because you're already losing too much. You're already going past the stop out level. Like the broker is trying to save you some money. That's why you have to choose those 1:100 leverages rather than the 1:500 that would permit you to like keep losing more money. Stop out happens once the stop out level has been crossed, so your open positions will be automatically closed to prevent a negative account balance. So okay, it's just kind of like the same thing. That was the level. This one is just like the action. So it's like both of them are explaining basically the same thing. So stop and limit orders. Buy stop, order placed above the current market price when price is rising. So buy stop is like saying prices are pro, like you have a resistance here and you expect price to break out of that resistance. So you put a buy stop, an order called a buy stop above there, saying that if price breaks above that resistance and comes to that price, let's say price is approaching like the number 8, it approaches number 8, it will activate, and if it keeps going, it keeps going. Sometimes you activate your buy stop and if my price doesn't go there, that's your L. But if you have a buy stop above a resistance or above another price level, price passes through it, it will activate that order. It will go ahead and activate that order. That's what a buy stop is. Does that make sense for what a buy stop is? You have a price level, That price level, buy stops are above that price level. If price goes above it, it activates the order. And for buy stops, you have like you have your stop loss at the bottom of it. Does that make sense to you guys? All right. Then the sell stop is just the vice versa, where it has the stop loss. It has the price is going down instead. Then you're putting orders below the current market price. You're putting orders that if price comes below a certain market price, it should activate and continue selling. It should continue selling. Then when it comes to buy limits, it's like price will come, it approaches a certain level, and then you expect that price to bounce off that level, and it keeps buying. So that is a buy stop. I mean, that's a buy limit, sorry. A buy limit, price is coming on a downtrend, it approaches it, it peaks, then it activates. That's where you have to make sure it fills your spread. If it doesn't fill your spread, you will see that price literally got close to 1 pip beside that order, and it goes up. That is like, this type of things are set when you're trying to like sleep, or you already know you've already marked up certain levels of price on your chart, and you're like, okay, another price will come here and you do this, you do that. But again, I for one, I only use market execution, which is I literally press buy or sell at the moment. I don't do none of these future moves. I can do it, but I don't do it. I always rather prefer watching how price gets to where I want it to get, and I'm deciding if I'm buying there or if I'm selling there. That's just how I like choose to do it. I feel like all of these things, the market makers just know where they at, and they will know how to manipulate with everything. So I'm not really trying to fall under their manipulation. I just let it be. Like again, you guys could take screenshots of these, but the more you learn how to trade with me, the more you understand that I just do straight out market executions, no others. No others. Like, I think people that I don't even know, probably like a lot of scalpers, like I scalp, but I still scalp with market execution. I don't do limits still. But some of my students, like in the past, were doing it, but not me though. All right. So chapter 5, different types of charts. In order to study how the price of a currency pair moves, you need some sort of way to look at historical and current price behavior. A chart, or more specifically, a price chart, happens to be the first tool that every trader using technical analysis needs to learn. Like, you need to know how to use the chart. You need to know the different type of charts. With me, there's only two types of charts that we will be using: the line charts and the candle stick charts. The other ones, the bar charts or whatever, we don't use those. A chart is simply a visual representation of a currency pair price over a set period of time. A chart aggregates every buy and sell transaction of a financial instrument, in our case, currency pairs, at any given moment. Types of charts. And this, I named all the TV types of charts here, which was line charts, bar charts, and candlestick charts. That was all I really much named, but it's more though. There's like there's more of them. Where is that? Like right here. These are different types of charts. These are different types of charts: step line, area, high low, Hakinashi, all of that type of stuff. Like, you see how they look? Different types of charts, they will make you look different. Like, I have someone in the past that was using this type of charts to trade, and I still know someone currently that uses this type of charts to trade, but he trades binary though, not actually forex. So there are different types of charts. We will be using this chart, which is called the candlestick chart, and the line charts. So the two charts we will be using with time, when I'll get to explain why we're using just those two charts. All right, so that one's like pretty simple. Like I said, if I'm going over something that you think you need more explanation over, please do bring it to my attention. There are just certain things I feel like is just, I think it's very much explanatory, so I don't really need to waste time on it. Like, this is like one of the most stressful reasons why I really didn't like teaching beginners, or like teaching without a course, because all this information, I don't like explaining to people. I like people to go read it by themselves and they come back and at a certain extent of experience, but it is what it is at this point. So different types of analysis. So it's not that you can that obviously we can't. Yeah, obviously we can't do guesswork and expect currency to go up or down. You need to make money, you need to understand how to analyze the charts. So our way of analyzing the chart is called technical analysis. There's technical analysis, there's fundamental. Oh, okay. Go ahead and take a screenshot, my bad. All right, I guess you got it. All right. So we have technical analysis, which is what we trade. And I say we, it's me and you guys in the nearest future, because that's what I trade, technical analysis. I don't do smart money concepts. I don't do market maker method, none of those things. Every strategy works as long as it makes you money, then you're doing something correctly. But this is what that worked for me. This was the first type of thing I started learning from day one as a trader until date. And it's been making me a shit ton of money. So why change it? So traders who use technical analysis are called technical traders. So I just like you could say you're a price action trader, honestly. Like it's still kind of like the same thing. It's all about the charts, studying past price movement. So one thing about technical analysis, you need to know how to read the candlesticks. That's why I'll go ahead and share this book in the charts, and you guys would like save the link so you can read through this book. You need to be able to, I read this book to the end. You need to know all these candlesticks, patterns, and everything, because like candlesticks will always tell a story. You need to be able to identify that story in the market. Like the price does not move from one region to another for no reason. There is a reason why it moves. So you need to be able to identify it before it moves. Anybody can analyze a chart before it happens. I mean, like after it happens, they will come, they'll say, oh, this was this, this was that, this was that. That's why the chart moved there. But a lot of people can analyze it before it happens. So if you're able to study that candlestick Bible, and also like every other book that was sent to you guys need to study that thing. It will help you. Personally, those are things that I read as well, and it helped me. So yeah, it's all about the charts, studying past price movements, determining future changes to the exchange rate. Strongly believe that price will follow its previous pattern, so it's more about probability here. Every strategy is about probability because we're studying previous things, and it's like, okay, around this area, price did that, so there's a probability the price will come back and do the same thing if it gives the same type of movement. Like trading is probability. Trading is not 100% guarantee, it's probability. But the thing is, the factors you put together to know if certain things will happen increases your probability of you winning. So another thing with you guys, don't go about trying to find a 100% guarantee strategy. You will never find it. Let me tell for people that don't know, for people that have zero idea about trading, let me just tell you guys about that today. You will never find a 100% strategy. You might find a strategy with 60%, that's still very much good. A strategy with 70%, 80%, and it might vary time to time depending on how you trade. Not every strategy will work the same throughout every market condition. That's just a market condition. Your strategy will be shit at. You don't need to bother yourself. You need to understand that, okay, this market condition, let me avoid it. This market condition is my best time to trade. As time goes on, you understand better. So fundamental analysis still again, look at past price movement to find trend patterns, rhythms in price action. Charting support and resistance levels, traders look to see if price has previously respected these levels and they believe it will repeat itself, and they analyze the trade's future movement. Use of indicators such as, I'm gonna just cancel this because honestly, I don't even use indicators no more. I trade with naked price, but I use FIB you guys could use the EMA as well to determine breakouts and price movements. With beginning levels to understand that, yes, you need things like moving averages, you need moving averages is the only indicator of advice you guys use. Another indicator is kind of slow. Indicators will be lagging, they are slow. They don't give exactly as price. They might be lagging like 2 hours late or an hour late. So those things, when you learn how to trade without all those indicators, you become a better trader. I don't use indicators. Like you see my chart that I've shown here, you don't see no indicators on there. Sentiment analysis, market sentiment, which is how traders feel or their perception for a certain economy or currency pair value. So sentimental analysis, like it comes with experience. There's some trades that I take just based off experience, just like it's just my sentiment. It's like I know it's going to happen. It's just like I know, I just know it's going to happen, and it happens. So sentimental analysis is like experience. Please, Samsung, stop writing on my screen. Thank you. I don't even know how to erase that thing. Every trader is an individual with own feelings in regards to reasons behind market movement. This sentiment is how traders choose to trade with or against the market. So all of this, you can like read it along the way. We're not going to waste our time. Fundamental analysis is basically with the news factors that will like impact the economy. We'll do things like economy, monetary policies, the GDP of the country, all those things, some things we learn in economics in secondary school and high school. Those type of things are the things that you see that we like here, economic factors, political factors, assessing an economic conditions to determine the movement in currency pairs via exchange rate. So sometimes when like if a good news comes out, it will help the economy to like, the market will go up. If a bad news comes out, it will push the market down instead. So those type of factors, when it comes to fundamentals, you understand. And there's like where we go to go see those economic news is called FOREX Factory. That's where we go to FOREX Factory. Like today, you guys, I dropped a trade idea, right? And there was this fundamental that came out where it says Fed Chair Powell speaks. This man, he has a very high impact in the market. Just a couple of words he can say in the market will make the market tremble. That's what happened today. He made the market tremble. Like this is like economy. Before you want to trade every day, you make sure you check this every single day as a trader. You want to make sure that, okay, if I'm getting into a trade, what is the economic saying? If I'm seeing a buy, is this buy a long-term buy or is it a short-term buy? If I'm seeing a sell, is it a short-term sell or is it a long-term sell? Is it economics permitting me to trade the way I want to trade right now? And I'm saying like this is very important. And sometimes it might seem like a strong spike in the market, like a really strong movement in the market because news was released. That's why the market moved the way it moved. So like that's why it's always good to have stop losses. Like trust me, I have lost a lot of money for not having stop losses in the past. Make sure you always have stop losses. I have lost a lot of money from news release because I didn't have no stop loss. You don't want to be me. You want to avoid all of that nonsense. So you can go ahead and take a screenshot of it so we can move on. Okay. So the next thing, let me go ahead and send you guys this link to this. And you open the link and tell me if it shows up. As it should show up. I don't know. Like that link should show up with the book. I think so. If it does, I'll share it to my let me just share it to the Telegram group. I don't know, I'm giving it out here. I'll just share it to the Telegram group, guys. This bullshit thing. I think my screen now is stuck. Yeah, I'll send it to the group. It's not, I know it's not gonna open there like that. My bad. Give me a second. I'm trying to look for that thing so I can send it. Where's the candlestick Bible? So that's one book for you guys. You guys check that out in the group chat and tell me if it opens up. Like every single detail that I'll like go over is something that is important. Like the people that will stay down to the grind will be the people that will benefit. You opened up, good. Is that a question you're answering for someone, Randall? Are you just dropping that bars? You're giving them free gem? Yeah, okay, yeah. So for news outcome, you don't know to like after the news release. They say news to be released at 7 o'clock. You only know the outcome after 7 o'clock. Like you can't know it before this. Before, if anybody knew it before, then everybody will be renewing this thing. Like it's gonna be like a cheap type of code. Feel me? So now we've gone over these little basic terminologies and everything. Hope you guys got your screenshots of all those likes. So the next thing that you guys will need to do is go ahead and create an account with TradingView. You go to TradingView. My internet is running slow these days. It's just annoying. Is that even 8? You go to TradingView, right? So I have the app on my computer, so that's like I don't even use the website, but you can see use the website and you do what you gotta do. So the TradingView, you need this. You need this. This is where you'll be chatting up your. We'll be looking at charts and everything when it's upcoming. You guys can be taking looks at FOREX Factory for now, but right now I don't even think you need it. Another thing you need is a broker. It's a broker as well for you to create your demo account with that broker. So let me go ahead and give me a second. I'm gonna send your broker to this chart. You go ahead and create an account with that broker and you start practicing. Not only start practicing, just create it on the call on Sunday. That's when we'll start going into things like support and resistance, trend lines, all those type of things. Like today, we're just doing like the terminologies. Like I said, we have beginner people's on here. I'm taking it slow. Some people might start coming in the calls more when we like doing more advanced things, but right now it's more of a beginner basis, everything. So, you know, like I want people to understand that every single step is very much important. You can't skip steps. You can't cheat the grind. There's no fucking way you can cheat the grind. There's literally no way. You just have to. All of this is very important that we have talked about today. So hopefully y'all got some value from it. Like our class sessions is gonna be like an hour, 30 minutes every day, depending on how much interaction we start having. Then I'll be able to like stay longer on the calls and talk more. But as of now, with everything that I've said, it's pretty much decent for today. You can continue the broker you already have. There's no problem if you already have a broker. Like if you guys want to be profitable traders some days, like not like someday, but one day from today, where you're literally making profits like this. Like you guys can see my screen. Maria Mustafa. Can you guys see like my entire screen, like my full screen? I know it's probably kind of small now, but if you guys want to be making profits like this, where you're making like 43K type of profits, that you can see this is a whole live account. This is a whole live account. Like I can't refresh it, but I'm moving around things and whatever. It's not no screenshot. For the people that think we're out here trading, demo trading, or we're selling courses to make money, or like, it's very funny. Some people, I have a paid Signal group, and some people they're like, we're mad that my Signal group is paid for. Like if you cannot afford something,